Record. All right, welcome everyone. These are our learning objectives for today. Let us begin. I'll invite a colleague to talk about this piece.
Yeah. Hi, everyone. My name is Lane Fury. I am a loan and outreach officer with the Cooperative Fund of New England. I'm based in Barre, Vermont, and I cover Vermont and New Hampshire. Hopefully, you already know something about the Cooperative Fund of New England because you're here somehow, but just to give a little overview, our vision is economic justice for all through thriving cooperative enterprises, which I think is pretty exciting. We've been doing the work for over 40 years now as a nonprofit community loan fund, working for economic, social, and racial justice by supporting co-op type businesses, co-ops themselves and businesses that are similar to co-ops, organizations similar to co-ops, or supporting co-op ecosystem. And we do that by providing financial products and services, and then also supporting business skill development like what we're doing right now. The majority of our funds are actually from individual investors who are really excited about supporting the co-op economy and socially responsible enterprises. So that's who we are. We're excited to have y'all.
Absolutely. And today we're going to be getting the conversation started around the key financial statements, primarily the income statement, the balance sheet, cash flow statement. But before we begin, I want to talk about financial intelligence. All right. And so this is your first opportunity to engage in the chat. What comes to mind when you hear financial intelligence? What does this even mean? What are we talking about? Are we just trying to sound cool over here? Partly. So drop some in the chat. I think largely what we're interested in hearing, or I should say, what we're interested in exploring when we say financial intelligence is really a set of skills, something that you can learn over time. And in this context, we're trying to get people to understand what the numbers really mean. And we're not going to get to, 201, 301, 401 level. We're kind of going to keep to a 101 level. So introductory. And we want to introduce you to various concepts that help you understand what numbers mean in regard to financial statements and reports, in regard to understanding what the numbers mean in those reports, and generally in regard to cooperating with other members of your co-op or with other business owners or partners that you might be interested in working with, right? So the first piece is the science piece. And so when we think of the science, we're thinking of, can you answer the question, when will you run out of cash? Can you answer the question, how profitable is your business really? These pieces come from the science portion of financial intelligence. And that's really just the financial statements. These are usually based on previous cycles of your business, if it's already existing, or it might be looking at industry standards. So what do bakeries usually perform like? What do barbershops usually perform like? What do businesses like yours typically perform like? And so they're all based on observable information, historical information, right? We also think about generally accepted accounting principles. These are guidelines that help accountants or bookkeepers make certain judgments or decisions in regard to presenting information using these three financial statements. So the first context of financial intelligence is really about being able to understand or make sense of the three financial statements. So it's really important that you continue to expose yourself to these statements. And today, again, we're just going to be exposing you to some of them. And we'll even have an opportunity to try to create an income statement, maybe the balance sheet if we have some time together. And so the key thing here is that statements are a reflection of reality. Statements are not reality. And I'll give you an example. Say you're on your way home and the mailman sees you and they say, hey, you got some lipstick on your collar, right? And you look to the right and you see a mirror and you wipe the mirror. That's not going to get your shirt clean. And in fact, if you go inside, your husband's going to be pretty angry at you. Where's that lipstick coming from, right? Because you tried to correct the mirror rather than correct your shirt. So the numbers, the statements are a reflection of reality, not actual reality. A little gender role reverse fun there. You gotta you gotta just get that one important point out. So the second piece of the science is kind of the anatomy of a financial statement. At the top, you're gonna see the name of the company. You're going to see the type of report it is. In this case, it's an income statement. You're going to see the date of the period that the statement is trying to talk about. You may also see whether or not it's in an accrual or cash basis. Now, most people think of numbers flowing through a business in a cash basis. They say, okay, I provide this service, I get paid, right? I do a haircut for you and you give me $20 or $30 or whatever. Or I mow your lawn and you pay me then. But a lot of businesses, they don't get paid right away, right? They get paid at a later date. And so a lot of the times using an accrual basis to account for your money is more helpful in understanding how the business is actually doing, because it uses what's called a matching principle to connect the expenses to the income in that given period. And so again, people usually think in cash basis, but most statements are prepared in accrual basis, especially the income statement. It's really looking at within this time frame, how we match the expenses to the income. And so you wouldn't necessarily include all the money you spent in 1 year if you bought a truck for $100,000, for example, in your income statement. You might break that down and depreciate it over time. So in a cash basis, you're just going to see I lost $100,000 last month. Whereas in an accrual basis, you'll see a portion of that. So we'll talk more about this, but you might just see that pop up. And then lastly, you might see, is it an actual or is it a pro forma? Actual speaks to what actually happened as far as we are now able to determine that. As far as the pro forma, that's usually a projection or a special case scenario playing out that we want to express using the financial statement, right? It's not historical, it's a projection, it's a story we're trying to tell about something, right? So these are the basic elements for any financial statement: the name, the type of report, the date or the period, whether it's an accrual or cash basis, maybe if it's a pro forma or actual. And maybe you might even see if it's in thousands or millions. And so if this was in thousands, this 250,000 would actually be 250 million, right? And so you might see that as well. So the other part of financial intelligence is about the art, right? And so the art side of this really pertains to understanding where the numbers are hard, right? And that means that they're well supported and relatively uncontroversial, or whether the numbers are soft, meaning they're highly dependent on judgment calls. So when you have your accountant trying to figure out where money should go and how do I express this, you might see some being very conservative, not being willing to put anything in that, we can't really assume that we're going to do 100,000 in sales this year because, last year we did 80,000, or we really only have 100 members, or whatever it is. Versus some people might be making highly biased judgments that reflect their own inclination or their own interpretation of reality, or even for clever reasons, right? You might see somebody says, you know what, we're going to classify all our office supplies as an expenditure that we can depreciate over the years rather than lose all that cash on our financial statements today. And that'll make you look more profitable. And that's a judgment call, right? You can do certain things when you're expressing these things. And so that's what we really want to understand. When is it hard? When is it soft? Because surprise, surprise, accountants and bookkeepers don't know everything. They're making assumptions and estimates continuously. So the science is really about this, the foundation, understanding the three financial statements, the containers of the information, and the art is really about the structure. How are the estimates and assumptions building up this story that we call the financial statement? And here, we just want to remind you guys that the numbers should inform your decision, not determine what you decide. It shouldn't be deterministic. This is how you use interpretation in regard to numbers. So the last thing in terms of the art is really the story, right? Somebody has a vision for a business, and so they have to create a narrative. Usually they demonstrate that financial feasibility using a pro forma statement, a financial statement about a projection into the future. And they tell a story about that. We're going to have this many customers because people are really digging this product right now. And so you communicate that narrative to a funder and to your members who might join. And then that then leads to the financial results after a year or so. And then you change your vision. And it's just that process over and over again. That's the story. So what are you trying to communicate to whom? And then results come, and then you reimagine your vision and then retell your story. This is an image I got from a conference I attended last week. I figured it was helpful to show you guys this part of it. And so I'm going to pass over to my colleague to discuss income statements. Carolyn?
Hey everybody, I'm Carolyn Edsel-Vetter. I'm the Cooperative Business Support Officer at CFNE. Along with Johan, we make up sort of the technical assistance and coaching arm of CFNE. So the first financial statement we're going to talk about is one that's probably going to be the most familiar to folks because it looks a lot like what we do in our home lives and our personal lives every day. What did I make? What did I earn? What did I spend? What's left at the end? So that's your income statement. You'll also see this called your profit and loss statement or your P&L because it's got your profit and your loss, or it might also be called your operating statement because it's really about what actually took place. How did money come in and go out mostly as a result of your business operations? One thing that's important to know for the income statement is it's for a period of time. So usually up at the top, you'll see, this is the income statement for such and such business. It's for this time period. It's for all of 2000. It's for December of 2000. It's for, whatever. Most common, it's going to be a year or a month. Sometimes you can see quarters also. And the key equation is what did you earn, your income. You can also see this called revenue or sales, minus what did you spend? What were your expenses? What were your costs? Equals your net income. And in non-co-op terms, this would be your profit. In co-op terms, we call this a surplus for technical reasons. But just to know that it's the surplus of what was put in by the members and is left to come back out to the members. So let's see. Johan, you want to go ahead and either launch or put in the chat the quiz?
So,
oh, awesome.
Okay, it's in the chat.
Yeah. So getting back to the distinction Johan made a minute ago about cash versus accrual accounting. When is revenue actually recorded? So if you look at your P&L for last month, are you seeing under income or under sales, are you seeing a reflection of what you've got for signed contracts, what product or service has actually been delivered, what invoices have been sent out, or what invoices have been paid? Those options are in the chat, and if people want to just throw your answer in there, 1, 2, 3, or 4.
All right, we're getting some 4s. Depends. That's a great answer. Some 3s.
Okay, so we've got some 3s, some 4s, and some it depends. So it depends is actually a great answer because it depends on whether you're keeping your books based on cash or when it's accrual. So on an accrual basis, it's actually when you sent that invoice. So your business has said, we have this money coming to us, it's time to get paid. You put that on there. If it's cash, it's when you actually receive that money into your account. So it does depend.
I'd like to just add on, when you send that invoice, you're assuming that that product or service is being delivered. So as you deliver that product and ship out that invoice, it's much more about recording revenue around that period of time,
Which gets real fun if you have a long cycle of delivery and also of billing, but that's a story for another time. Okay, so here's an example of an actual income statement. So this is for an imaginary catering co-op. Total sales revenue. So they earned, again, looking at the very top, we can see it's for a time period. It's for January 1st through December 31st, 2020. Over the course of the entire year, they earned $250,000. So they've got total sales revenue or income. The first expense that comes out of that is their cost of sales, or you also see this called cost of goods sold, or just abbreviated as COGS. And that's what were the expenses that actually went into making that thing or doing that service. So it's really, you can also see this called direct costs. So in the case of a catering company, that's probably mostly the food. Depending on your business, and how you're comparing yourself to other businesses in your industry, you might include the direct labor to make that food also, but mostly it's just going to be the food because that's your product. So you subtract out the cost directly related to making the food and you've got your gross profit. So just after making their thing, they have $100,000 left. Now out of that, they have to cover all the rest of their operating expenses for the year. So in this case, their operating expenses were $87,000, and that meant paying the rent, paying however they're delivering that food, the insurance, advertising to build up their business. All of those things are operating expenses. You'll also see these referred to as fixed costs because, you're going to pay, no matter how many catering contracts you have, you're going to pay your insurance, hopefully. You're going to pay your rent, hopefully. Those are predictable, fixed, steady costs. So what's left? So you had your revenue of $250,000. You subtracted out both your cost of goods sold and all of your fixed costs, all of your operating expenses. And of that $250,000, they have $13,000 left. That's their total net income from operations. Funky thing that you'll see sometimes on an income statement also is other income and expense. So that might mean something that's not like directly related to the main business. So maybe they have a rental space that they're getting some extra income from, or something like that. So that also gets included in your income. So you end up with income before tax, you take out your taxes, and then you're left with your net profit. So that's sort of how money flows through the income statement. I hate doing slides that have bunches of numbers on them. And Johan, we go to the next slide. Here's another way to present a whole bunch of numbers in a way that feels more relevant. And I intentionally left this slide in Spanish because for those of you who do not have Spanish, this is what, like, a lot of us, when we see numbers for the first time, this is what we experience, is like, I see things there, but I don't really know what that means. But, I'll ask you, like, if you look just at that dollar bill down the side, where we've got our cost of goods sold, our payroll, our other costs, and our net profit, you can look there and just at a glance, who can put in the chat, what was this co-op's biggest expense? Just as a general category, what was their biggest expense this year? Yeah, payroll. I mean, you can see right there, there's a big like blue 50%, half of those expenses were payroll. So, as you're deciding what numbers to communicate with your co-op, think about ways to kind of like make it visible without making it scary. And using a chart, using a graphic to show what's the breakdown can be a really good way to do that. I will pass it off to Lane.
How's everybody doing? Got a lot of numbers going, got a lot of info. We're good? Good to keep going. Great. I'm seeing smiles and thumbs up. So hopefully that's true for a lot of folks. 1 down, 2 to go on the financial statements. We're now going to talk about the balance sheet. So the balance sheet, as opposed to the income statement, which is covering a period, the balance sheet is just at a point in time. What do we have? What do we owe people? That's what it's telling us. So the key equation here is our assets, what we own, should equal our liabilities, what we owe to other people, plus our equity, what our owners have invested. So one way to think about that, it should balance out on that. We have all this stuff, assets. Can folks chat in, what's an example of an asset? What's something that you might have as a business? We can use a catering company or your own co-op. Gear, right? You got camera gear, you got your, whatever it is you're doing to do your stuff, your vehicles, those are going to be some assets. Refrigerator, some equipment. Yeah, lots of equipment. How about your bank account? If we've got, yeah, exactly. Nice. You got me on that one. Cash in the bank, right? Property, that would be great. Not every business has that, but that's a helpful thing to have, place to do your business. Yeah, we'll talk about what's an asset versus a liability. So an asset is what you have, those kinds of things we're talking about. There's some other kinds of like assets that are sometimes a little harder to think about. Like we were talking about this cash versus accrual. There's an asset for when you invoice somebody, you say, you owe me money. And it's called your accounts receivable. That's like money that you're expecting to have come in. It hasn't hit your bank account yet, but you're expecting it to come in because you already did that work and you billed somebody for it. So that's an asset. That's something that you own. You just don't have it yet. But liabilities on the inventory is definitely, yeah, considered to be an asset. That's what you have. So for that catering company, that's going to be your like unprocessed food, your like grated cheese that you haven't yet melted onto the pizza, you know. And then yeah, the liabilities on the other side are what you owe to people, what's going to go back out the door. So that would be if somebody sent you a bill that you haven't paid yet. So the vendor that sells you the cheese, you got to actually pay them for it. You're probably not going to hand them cash when they walk in the door. They're going to hand you a bill and you're going to pay that. So that will be listed as your accounts payable. Other liabilities, what might be other things you would owe somebody outside the business? Any ideas? Loans, great, yes. We're the Cooperative Fund of New England. So we often are giving loans to many of you all, right? And so when you owe people money, that's going to be another liability. And then that equity piece is sometimes the squishiest one for me to think about. The equity is what we owe to the owners, what the owners invested initially. And then also as the business grows in value, as there's net income in the business, whatever other, that turns into equity. That might be for worker co-ops, would be internal capital accounts. There's a lot of different things that can go in that equity. It's possible to have outside investors making investments that could become equity, which you owe to your owners. One thing about balance sheet is that we're hoping that we're not going to see a lot of negative numbers on there, because assets, what you own, hopefully you don't negative own something, right? What does that even mean? If that's the case, it should probably be a liability. A liability, what you owe others, that could even be like your credit card bill. Hopefully you don't negative, you know, if you overpaid your credit card, maybe that would be a negative number. But if you negative owe somebody something, that should be an asset, right? So we don't want to see a lot of negative numbers on there. There's a couple cases where a negative number, it might show up in the equity, and that's still a red flag to say, what's going on here that we negative, like our owners owe something back into the business. That would be an indicator of kind of a long-term problem. And it does connect to the profit and loss statement. You'll see the net income from the profit and loss statement showing up on the balance sheet. So if we go to the next slide, we have a little example of what that balance sheet looks like. You want to add something, Johan?
Yeah, I would love to. I would just like to encourage people to maybe look at it from another perspective, from the personal perspective. Think about what you own, think about what you owe, the bills you have to pay, and then think about what's left over. That's your net worth. You know, it kind of translates in the same way for the company. And when you're thinking about your assets, think of things that you can turn into cash, things that you can sell. That'll give you cash. That's what an asset is. And then when we think of a liability, think of things that take cash out of your pocket every month or a long-term commitment you have. So what can you turn into cash? Asset. What costs you cash? Liability. All right, so that's my 2 cents.
Great, thank you.
Hope it was helpful.
So you can see this example balance sheet. We've got some nice little like fireworks going on the side of the annotations. I don't know if other people can see that. But so this is what the balance sheet's going to look like in that numbers format. And we can see those assets add up here. Those current assets, that's going to be those things that are already cash, like Johan's talking about cash itself, or those accounts receivable I was mentioning, cash you're expecting to come in immediately. Whereas the fixed assets, those are going to be the things that people were chatting in around, like a refrigerator, a vehicle. It's not cash yet, but it could become cash, but it's, you know, it's like a hard fixed asset. So our total assets over here, 40,000. Liabilities, those are current liabilities. Again, similar kind of money that's owed out right now is the current liabilities, and the longer term liabilities, that's money that we're going to have to pay out, but it's not due within this upcoming year. And then the equity, like I had mentioned, the capital accounts, those are, you know, what the individual owners have accrued in income. And then retained earnings, that's how much money, that's the net income over time getting added up. So the current year net income, 13,000. And this is something that happens at the end of the year that gets folded back into retained earnings. So we can see here, our total assets, 40,000. Should equal our total liabilities, 20,000, plus our total equity, 20,000, for a total of 40,000 again. That's the balance piece of the balance sheet. Anything else y'all want to add? Any questions on the balance sheet? Can hand it off there if there's no questions.
So the third statement that you may never see, but it exists, is the cash flow statement. Usually people use the cash flow to project out their operations budget, and you guys will see that later. But the cash flow statement is an actual statement, and it has its own way of operating. This statement is kind of like an income statement, but it tracks changes in the balance sheet. And so the first line is at the top, you see cash flow from operations. That looks at what cash came into your business and out of your business from an operating perspective, you know, paying employees, buying inventory, all the cash that actually came out to operate your business, right? Then we see cash from, we see net income, additions to cash, depreciation, lots of thing here, all the way down to the second bolded line in white. It says cash flow from investing, right under net cash from operations. And so that's money that flows in and out your business as it pertains to investing in your business. So buying equipment, larger things like that. How did you invest in your business, right? It's not about investing in the stock market. It's about investing in things that help your business, right? So let's see, do we have an example there? Purchase of equipment. That's, you know, example I already gave, but that's a larger, which we're going to see. The next thing is financing. And so this is in regard to money coming into your business from a lender or an investor. This is how do you finance your business, fund your business. And for a co-op, you can include this next section right under there, kind of the equity piece, right? People giving their money to become an owner, or people lending you money like a member loan to fund certain aspects of your business. So how are you financing your business? What type of capital is coming in to finance things, you know, loans, investments, member loans, member donations, stuff like that, stuff that's financing things you want to do. And so this is something that you may not see generally, but it is a financial statement, and just wanted to expose you guys to that, okay? Now it's time for an activity. I hope some of that stuck in, but you're really gonna get your bang from your buck with this because of practice. So I'm gonna stop sharing my screen and I'm gonna drop a link in the chat. And in that link is gonna be a spreadsheet that has an income statement and a balance sheet. And the goal is going to be to fill out the income statement, okay? When we fill out the income statement, we're looking at the text below the document and we're just adding it up. We're just putting it in the proper slots. You're going to have a team to work with, and we're going to have about 10 minutes or so to fill this out. If you get to the balance sheet, good. but we're gonna just focus on the income statement, okay? So let's do some workout rooms. 3, 2, 1. All right. Everybody should be back now. Okay, so I'm gonna share my screen and we're gonna just talk through the process. This wasn't about getting the right answers because there was a glitch in one of the rooms. So we're not gonna have all the same answers, but we're just gonna talk through the process, okay? So as far as total sales, and you can all unmute yourself at this point, unless there's a noise in the background. I have a little bit, so please excuse me. Total sales, we should have gotten 50,000. I think that's probably something we can all do. All right. Did anybody not get 50,000? Let's drop it in the chat. And, you know, to me, my question is here, even if you construct a balance, an income statement and it has this information, is that information helpful to you guys? Is that, what could be better about that line? And again, anybody can unmute themselves. Let's just chat. To me, it just kind of lumped everything in. If I work for this company, I don't know if the banana cupcake is selling better than the blueberry cupcake. So this is really dependent on who this is for, right? Because you can put that information right there if you wanted to, under your revenue, the different services or goods you provide. And that way you can compare multiple services that you provide to see which is more, which generates more revenue. The other thing here is that revenue is an estimate. Even though we're looking back in time, we have services that we provided for and send the invoices out that we might not have received the cash yet. So that's just one thing to think about. The second line is the cost of goods. Most people should have gotten 10,000 if you were in group A. In group B, they had a 50%, a 250. Their cost of good was $2.50. Lane and some of those crew talked about that. So they would have come up with a different number here, but I think their number was correct. Lane? So your cost of goods is kind of a big lever for you in determining how profitable your business actually is, right? You want to get the cost of goods down if possible. You want to get it cheaper. If it costs you $2.50, as in group B, to create your product, right? You're gonna have half the amount of gross profit and then half the amount of gross profit going into supporting your operating expenses, versus if it is $1, then you have 40%, $40,000 left over. So the higher your gross profit, the lesser your margins, or the higher cost of goods, the less your gross profit. So that's a pretty important piece, right? And these are the typical inputs that you're gonna see. Next, we have the total operating expense. Now, this one was probably a tricky one. Everybody should have had 15,000 a year for the cashier, 25,000 a year for the baker, and so that's 40,000. We can all agree with that. And then we know rent was 500 a month, and so we said we times that by 12 months, because this is maybe looking at a year, and that gives us $6,000. All right, 500 times 12, $6,000. So we paid $6,000 of rent for the year. So that's 40,000 for employees and 6,000 for rent. Then we paid about 500 a month in operating the truck and other insurances, utilities, stuff like that. So that's another $6,000. So we're looking at $40,000 for people, $6,000 for rent, $6,000 for the utilities. So that's $52,000. Now, the tricky piece is what some people did, anticipating a lesson that we have to learn, which is called depreciation. When you buy a truck for $10,000, do you count the $10,000 that year, that month? If you do, it's going to look like you took a big hit in your profitability and your cash, right? Even though the cash went down, you might not represent that on your income statement that way. that's called depreciation. This is one of the soft pieces of financial intelligence. What the depreciation allows you to do is spread the cost of that purchase out to the useful life of the equipment. If you think the vehicle is going to last you 10 years, you can divide 10,000 by 10 and spread it out. But you're only going to put 1,000, which is 10,000 divided by 10, into your income statement. Whereas in your balance sheet, you will see the actual cost of that asset reflected under asset, right? And you might take out depreciation if you're in year 3 or something, you know, it's lost $3,000 worth of worth or something like that. But that's how you engage the art, right? Depreciation is one clear example. So here we put that $10,000 divided by 10 equals 1,000 under depreciation rather than in your total operating expenses, right? Then we had some givens, which interest was a given, taxes was a given. And the reason why we might separate these things out from your operating expense is because you might want to know how your business is doing before it pays its interest back on its loan, before it pays taxes, before you account for depreciation, which is not a real cash cost. It's just an expression of that activity. And so then we see a net loss of 43,000 at the bottom. So this is tough. For anybody who did the balance sheet, I don't know if you looked at the time stamps, but this one is at the end of the year, 2020, and the balance sheet was actually January 1st. So you have a group of excited people say, we're gonna create this business together, right? They had $3,000. Then they paid $500 for inventory, all right? And they also have the truck, which is $10,000, they just bought it. That brings their total assets to $13,000. Down, when you think about the loan, it says they paid $2,000 for the year, so that's the current portion of the loan, right? That's what's due that year. Then they also had to pay for that inventory, right? And then the remainder of the loan is there. So that brings their total liabilities to $10,000. And then the equation, as Lynn had pointed out before, is assets minus liabilities. So assets, 13,000 minus liabilities, 10,500 equals equity. That works out, right? 13,000 minus 10,500 equals 2,500. You can also say assets equal liabilities plus equity, which is a little math that accountants do just to reconfigure the thing. And so we say liabilities plus equity is 10,000 plus 2,500. That's 1,300. Should be equal to assets. Say assets should be equal to your liabilities plus equity. So that's just something else you're going to see. And we see that this balanced. Any change that happens up here in the assets piece is going to be reflected down here in the liabilities piece. And so that's that. Any questions here? Unmute yourself, drop it in, and we're going to try to get through a little bit of the rest. It's okay. With the Lane, Carolyn, you guys want to take this one? Is amortizing different from depreciation?
I can answer that in the chat because it's a little technical if Lane wants to keep rolling with the budgeting.
Awesome. Great. Yeah.
Absolutely.
The answer quickly is they're different, but they're different in kind of complicated ways. So we don't need everyone to fully understand that in this moment, but yeah, we'll answer the question for Barbara in the chat. Great. Thank you everybody for rolling with us with that activity. It was kind of fun for me, if a little bit bumpy. So like glad to get to try it out with you all. We're moving into some financial planning tools now. So we did the financial statements, 3 financial statements from the past. We're now looking at financial planning statements or tools for the future. The first one is budgets. Budgets, we actually, are familiar with as with the balance sheet, like Johan was saying, we've got personal budgets too, maybe. We also are familiar with budgets in other contexts. So the budget, I think for most co-ops, one of the things that's really important to think about is, why do I care what the budget is as an individual? If I'm not on the finance team, if I'm not putting together the budget, why does it matter to me? First thing is, a lot of times co-op members are being asked to approve a budget. So we need to understand what's in there and be able to ask questions about it. There's that approval, the process for budgeting. Hopefully looks like some folks from the finance team putting together a budget using input from other members in the co-op maybe, depending on what that process is, and hopefully approving it before the period that you're actually budgeting for. And then once we're in that period, we're also going to review it. So what is in a budget? A budget's going to look a lot like your income statement, except it's for the future. So you're going to be looking at your income, you're going to be looking at your expenses. For startups, you're going to have to use those pro forma projections. Hopefully that's market research that you did. And your business plan to say, what is our budget for this year? And for established businesses, you get to look at your historic financials as well, which is great, right? The really important thing is you don't get to totally just make up what your numbers are. Your budget isn't, we hope we sell 100,000 cupcakes, right? Your budget is, well, we sold 10,000 cupcakes last year. How are we, marketing ourselves? How are we hitting new sectors? How are we increasing our pricing? What are the specific things we're going to do to have information about our future sales? That's what this garbage in, garbage out is telling us. If we just say, we'd like to sell 100,000 cupcakes and we put that in, the information we're going to get back out is not actually going to be very helpful, right? So one big key for the budgets is that as we go through the year, instead of like maybe what happened here with the example where we were losing a lot of money on this cupcake company, we want to actually know what the budget is for the year, and we want to take time throughout the year to take a peek at that budget and say, how are we doing compared to how are our actual numbers compared to what we hope our numbers will be? And that's another report called a budget to actual. So this is giving us a couple different sets of numbers. This is our 2020 actuals. This is what we did last year, what we made last year. We're back to the catering co-op, super separate catering co-op, made $250,000 last year. And this year, we get to look at that number for what we're budgeting and say, how much do we think it's going to grow? What are the assumptions behind it on just that revenue? The other pieces we want to look at, as we mentioned, the cost of goods sold, that's typically going to be tied right into the revenue number, right? It's going to be directly proportionate how much that increases, whereas those operating expenses might be a little more fixed year to year. They don't necessarily tie directly to that revenue number. We also, anything Carolyn or Johan you want to add about budget at this part of it? I'm going to talk a little bit more about how we also want it to look seasonal. So if you look at the next slide, we'll budget for a year. Usually a year is a good period to budget for, but we also want to, if you want to advance it, Johan. We also want to see what does that mean on a month-to-month basis. And this is an important thing also to be looking at, again, not necessarily even as somebody who's creating the budget, but just to be able to ask the question as a co-op member who's going to be voting, do we want to approve this budget? What does this actually look like month to month? Is this a feasible amount of work in a month? Or what does this mean for our staffing in a month, right? If we're saying, January, February, March, a lot of seasonal businesses are going to have leaner months and more intensive months. Is this actually a reasonable amount of work to do over those summer months to make up for a leaner winter? How are we actually thinking about that? And how is this tying into our assumptions? And yeah, taking a look at those bottom line expenses. Do these, just being able to ask the question, does this make sense to me? Do I understand what this means for our business? Yeah, in this piece, just a little bit of a zoom in. We also have the opportunity to look more directly, like Johan was saying, we want to look not just at cupcakes overall, and in this case for catering, not just sales revenue overall, but which types of items are we, which types of revenue are we expecting to grow? Which ones are we not going to grow as much? Which kinds of revenue have we decided as a business this one isn't actually really helping us? Those kinds of things. Any questions on the budget? We can move right along. If not.
Yeah, so just in the last couple of minutes, I'm going to talk a little bit about cash management and cash flow projection. So Johan shared with you the cash flow statement that shows sort of where did cash go? And this is more of the in the moment where as a co-op member, you might say, okay, if we lost a big contract this month, or we had a big unexpected expense, would we be okay next month or the month after? So it's really just tracking how cash moves in and out. And starting with your beginning balance actually from your bank account, and then seeing the money flow in and out over the course of a month, and then hopefully reconciling periodically to see, does our projection match up with reality, and readjusting it. Next slide. So this is teeny tiny, and you don't need to be able to see the numbers to get the main idea, but these are just the parts of a cash flow projection. So up at the top, you're going to start out number one with your cash on hand each month. In number two, you're adding in any sources of cash that are coming in. So, any payments that you're getting, and if you're a business that gets deposits and stuff, this might be different than the numbers that are on your profit and loss statement, because when that money's coming in and when it's realized and on an accrual basis could be a little different. And section 3 is all of your cash going out, and there's so these would be all the expenses that you'd have on your profit and loss statement, but also down in section 4, there's going to be some things that are uses of cash that are really going to show up on your balance sheet. So things like a loan payment, or a capital purchase that you're like using cash for, or your patronage payouts to your members if you're paying them some of that patronage out in cash. That's a use of cash that's not going to show up on your income statement. So once you sort of worked all that out, at the end, you've got where you stand with your cash at the end of the month, and that rolls up. Johan, if you want to go to the next slide, it rolls right up from the end of one month. Where you end is where you start the next month. So the key thing about this is just that if, as you're meeting as a co-op and you're thinking like, hey, can we make this a big move, or we just had this unforeseen thing happen and we're worried, sometimes looking at your profit and loss statement is only going to give you a partial picture, because it shows you, were you profitable in a given month, but it might not really be showing you what's happening with the availability of cash. So this is another tool that you could, ask your finance person to produce for you, to give you a little more security of like, yeah, we can pay our bills, because, or we can shift our tactics. What would happen if we started asking for a bigger deposit up front? What would happen if we got more aggressive about collecting outstanding bills? It's taking people 2 months to pay. What if we incentivize them to pay faster? So those are ways that, by understanding where cash is flowing in and out of your business, you can have a little more control over how it's going in the moment. And I think we do not have time for the second activity, but cool thing, I will send out, it's another spreadsheet exercise, so you can have optional bonus homework, and we'll send you virtual gold stars. But there's some exercises to play around with, both a budget and an income, a cash flow statement. So we'll send those out with the slides and recording.
Absolutely. Homework. Fun.
Optional bonus homework for all the Hermione Grangers in the room.
All right. So now we can kind of start wrapping up with a few takeaways. One of the things that I just wanted to encourage you guys to do is to continue to build your financial literacy. And in your company, you can then take your little bit of knowledge and start mentoring others. So if you want to create a financially intelligent company, start with yourself and make sure you're able to just understand what the financial statements are and what are they saying, and then be able to mentor others on the basics. So that's a broad scale mentoring, but it starts with you. Then I would encourage team training. As you can tell, one training is not going to be enough. Not only does it take a lot of time, it is just necessary for you to continually expose yourself to this. 5 or 6, 7 times you might want to take a listen at someone describing the income statement to really get into the peculiarities of that. And then, you know, if you guys are offering trainings at your company level, repeat the trainings, as I said, and then offer classes regularly, maybe once a month, maybe a little less regularly, and incentivize attendance. You want everybody to show up at different points in time. And then, you know, one of the things that maybe come out of like an open book management, which maybe Carolyn could speak to, is just these idea of weekly meetings where you discuss different things that are important to your financial statements, right? Like your cost of goods or your personnel or this particular product, how is it doing? The banana cupcakes, we really want to get banana cupcakes going this month. You know, we want to get blueberries going next month or whatever, because blueberries are cheap. Whatever it is, you want to put that in front of people, choose 2 or 3 and some trends, explain where they come from, explain why they're important, and how everyone's jobs affect them. How does your task over there as a stocker affect this, right? The longer you take the stock, our personnel costs are going up, and you know, our bottom line is going down. Things like that, whatever it is, just in a way that everybody gets in context how their role affects these numbers. And that'll be the most important thing, I think. And then the last 2 points, be transparent, but don't overshare. You can tell that these statements can be overwhelming, just a bunch of numbers. So you want to slowly introduce to different pieces. You want to go line from line if you're looking at a financial statement. And when you're explaining to other people, you want to do point by point, whatever you're interested in. And use visual aids and add context. People use scorecards, lots of different things like that. I don't know if you want to share anything on this, or do we just...
Yeah, I mean, just really quickly to sort of reinforce, about a third of you guys in your registration said you're really looking for ways to engage other members in your co-op and thinking about this. So, you know, first is sort of share the plan. So what are the key numbers that the co-op has to meet for their plan to succeed? So like in this instance, maybe it's, we have a benchmark, we're going to try and keep our cost of goods sold at or below 15%. And you have just your big like $1 scorecard to let people know how they're doing with meeting that goal. Next slide. Another one might be, you know, people can get real focused, whatever you're reporting out on and incentivizing, that's what people are going to pay attention to. So if it's like, we want to get jobs done really quickly and on schedule, but then people are rushing and customer satisfaction is suffering, that could be a problem. So picking like kind of a balance of what you're going to report out on. So maybe you have a customer happiness goal and you're sharing out the results from like, you know, a customer satisfaction survey or something. So whatever those levers are that are within individual members' control to help the plan succeed, report out on those. Next one. And the last one is a really simple graph like this that shows like what's the plan versus what's actually happening can be really powerful to just spark, hey, what happened here? Why are we lower? Why are we higher? Are there things we can do to get to where we want to be? So letting people know regularly how you're doing compared to plan and asking why. That's what I got.
These are a few of the questions that came in. So I hope we kind of got to some of them, you know, key information when reporting, right? Make sure you share that with your team, but you're also always going to be looking at cost of goods and personnel largely. How do you engage people who feel unsure? A lot of people are scared of the numbers. Just take it line by line, get your knowledge down and mentor them, you know, presenting data in ways people can understand. That's mean don't overshare, use visual cues, helping members understand why and how we're making financial decisions. Again, that's connecting their tasks to it and understanding why that key indicator is important. How what you keep track of can inform buying decisions. You know, that speaks to the same thing. Items, tools, explaining accrual accounting, that's probably going to be big because it's a little counterintuitive. I don't even think we kind of got to the core of it for a lot of you here today. But the most important thing there is matching, just matching within a time frame, if that makes any sense. You want to just make sure whatever money you have coming in is connected to the money that you're spending that time period for that year. So you won't include expenses from other years in that year because you're trying to match a portion of those expenses to the income. So that's really the most important thing with accrual accounting, but you guys will dive into that. And then how a co-op operates differently than a typical business. I think this is where the opportunity is. A lot of employers don't feel comfortable sharing this information with their team, but co-ops can and should, right? Regular businesses should too. I shouldn't say regular businesses, but you know, typical corporations should too, but they don't. And I think this is a real opportunity for us as cooperators. You know. So if you have any questions, feel free to reach out to us. We'll provide emails in the next slide. If you're interested in our 201, because we just got to the income statement today, reach out. And there are some resources on the screen. Take a screenshot of this or write these down. We've got a few different templates online that you can make use of. And the University of Wisconsin is a great resource, as well as Dowie and that other one. So here's our contact information for anyone who is interested in talking a little bit more. If you're interested in coaching, reach out to myself or Carolyn. If you're interested in you getting a loan, reach out to Lynn, and you know, Lynn can give you some immediate feedback and send you over to us if we need to do any deep dives. And we're here for you. So we appreciate you being here. We appreciate your time. As the count said, you know, numbers are fun. I don't know if you said that, but it's true. All right.
Oh, I'm just going to add, because somebody just asked about it. If you registered, you'll get a recording and the slides and your optional homework. If you didn't register, feel free to, you know, drop your email in the chat or reach out to one of us directly. Swain, we got you. We know that you're here. Yeah, thank you all so much.
Thanks, everybody.
Thank you. Thank you.